Hello and welcome to Options Guide TV. My name is Brian Overby. I'm the author of The Options Playbook, and I will be your host for the next 25 minutes here on Options Guide TV. So, if there is an earnings day, today is that day. We have a plethora of people announcing earnings today. So, I'm going to name them off after market. We have Microsoft, Amazon, Meta, Alphabet, Ford, Qualcomm. So just a nutty day of earnings. And I'm going to focus on Alphabet. We have our Amazon trade on. We did put it on, and then we got a little bit, everybody once again got a little scared of something and got spooked, I guess would be the best way to say it. And Amazon ran down. Well, now we're back up. It's up $5 on the day. It's up 2%. We put our trade on, our long butterfly on for $3.60. And right now it's trading for about $4. So it's actually profitable. And I did want to talk a little bit about that, in that the stock hasn't moved a ton, but the butterfly has. And one of the things is that if you're within your strike prices and you get a little bit bumped up in implied volatility, the cost of the butterfly will go up. So if you're within the strike prices, we're within the wings of the butterfly. Implied volatility will drive up option prices. Now, if you're correct on your forecast, if it comes back down, you want implied volatility to go away, because you need the short options in the butterfly to decay. And that's part of the reason why we like to do butterflies around earnings, in particular on fairly expensive stocks, because you get a pump up in premium on implied volatility because of the stock price. You get a pump up implied volatility because of the event, the earnings event, and then it all has to implode because they're going to announce earnings, volatility is going to come down, and you do a near-term expiration. If you're right on your forecast, your butterfly can reward you very quickly. So that is the reason why I like to look at butterflies around earnings. And we do a show, 2 days a week. We do advanced trades here on Options Guide TV. And then on Fridays, we're looking to do Fundamental Fridays, where we're trying to bring some beginning option traders into the fold. And so far, it's been a nice little mix, but today is earnings day, without a doubt. And so let's jump right into it. Let's run to the Trader Pro software. We'll go back and take a quick peek on the Amazon trade, but I'm going to keep it very, very similar with Alphabet. Now, I would say, and I'll be blunt, in my portfolio, and I probably need to do a little bit of adjusting in it, Google right now, or Alphabet, is my largest holding. And that's only because it's had such a strong run up. It's the biggest percentage of my longer term portfolio. Netflix is number 2, but Netflix I haven't owned as long as Google, and I rode it all the way up and it came all the way back down, and then I doubled down after the Warner Brothers thing went away. Bought some deep in the money calls actually to try to add to that position. So that is my second biggest position that's in my account. Now that's in longer term holdings. I still like Google around earnings. And I do think that Alphabet actually had a fairly decent strategy in that, there were dealing with a lot of antitrust issues, a lot of issues with being a potential monopoly. They seem to not do very well in their AI strategy during that period. Once that got dropped, all of a sudden, Alphabet's a leader in that space. And they have, I use all the GPTs. I use as many as possible. I subscribe to I think 3 or 4 of them, where I'm actually paying all the fees for them. And I do think that Gemini is very strong. It's very strong, obviously, on things that actually Google search is strong on. And data is key. They have all the YouTube data, and that's such a big deal when you're trying to train an AI, a bot, or an AI website, if you will. So I like Google going into earnings. I think a little bit of the pullback that we saw. Well, let's pull up the chart and let's look at it. And I'm going to go a little bit wider on my Google trade than on the We're going to give ourselves a little bit more upside here. But by the way, Nucor did great after we rolled our call option. We rolled that last Monday. Nucor is doing wonderful. Like right in here when we had this little pullback, now we're bumping up, and we just broke out to a new high. It actually looks a little bit like Amazon, but Amazon isn't an all-time high. We had that breakout, the drawdown and the breakout above. Now we're looking at Google. Very similar charts in that the draw down, draw up, and now we're looking to do a breakout heading into their earnings report. All right, so I like the way the chart looks. I like the format of it. I like the breakout potential right here. We got the catalyst actually to try to drive it higher after the close today. Let's get long an open wing butterfly in Google. So here's our trade. We're going to be buying the near-term expiration, the May 22nd, let's try that over again. Okay, so we're going to look to do an open wing butterfly in Google ahead of their earnings report. We're going to use the nearest expiration, which is this Friday, May 1st, a couple days away. So they're going to announce on Thursday. We're going to have all day. We're going to announce on Wednesday. Then we're going to have all day Thursday, all day Friday for these to trade. And then the options would expire after that day. So this is a very speculative trade, and it's all centered around a perceived good earnings event. So in this instance, we're looking at buying the 360 strike call, selling 2 of the 375 strike calls, and then buying 1 of the 382.50 strike calls, $382.50. Now, the long spread in our butterfly is 15 points wide. The short spread is 7.5 points wide. So if the butterfly blows through all of our strikes to the upside, you take 15 minus 7.5. That means the butterfly has to trade for somewhere around 7.5. And right now, the midpoint is $3 on this trade. So we can execute this. We're going to put it right at $3. And we would still be profitable above and beyond anywhere above the highest strike, which is $382.50. Now, this is only possible because of all the things that I mentioned. Higher price stock, earnings. Well, those are the 2 things that drive when volatility is high. When volatility is high, and you can sell 2 of these option contracts out of the money, you actually drive down, or let me say that a different way. When volatility is high, like it is right now, the price of the butterfly will come down. When volatility goes away and you are correct on your forecasts, and we start heading towards that 375 strike, that's a midpoint of our butterfly, then that goes away because you have to buy those back and you want to pay as little as possible. So time decay and a crunch and implied volatility, then the value of your butterfly will go up. That's simple. So here's our trade. We're looking to use the May 1st expiration. We're buying the 360 strikes, selling 2 of the 375 strikes, and then buying 1 of the 382.50 strike. The midpoint on that trade right now is $3, and we're going to send it down to the trading floor. And boom goes the dynamite. The order's down at the trading floor, and we're going to work it, and we want to make sure that we get executed on that trade before we leave today. Now let's run and look at our portfolio. And we have, well, actually, I'm going to run over to the what if calculator, and I'm going to pull up the Amazon trade. So here's the Amazon trade in the what if calculator. We can send that to the trade ticket down below. It's $4 right now. When we put the trade on, we looked at $3.66. That's right. We had a lot of 66s going on. $3.66 per 1x2x1 butterfly. Right now it's trading for $4. So we're up 40 cents on the trade. Here is, once again, we have a $265 stock, fairly expensive stock. Implied volatility is creeping up. We are just outside of the strike. So the implied volatility is helping drive the price, but we also had some positive delta because when we did the trade, we were close, but we weren't. I think we were just below the 265 strike. We might have been around 262 or so, somewhere in that range. We were just out of the money on that trade. So then underlying stock, if it goes to the 280 mark, the maximum that we could make on this trade would be 15 points. So we're 15 points minus the $3.66. That's the maximum we can make. Above and beyond, we got, once again, the same scenario that our short spread is 7.5 points relative to our long spread. So 15 minus 7.5 ends up with 7.5. So at that point, from that point on, the butterfly would trade at expiration anywhere around $7.50. We paid $3.60 for it. Right now, this is trading for $4. If I were to put it on right now, I would slide it up and make it a little bit cheaper. I would look to start at the 270 strike and then sell two of the 280s, or the 270s, then sell the 285 strike, and then go up 7.5 points and do the 290, 250. In other words, I'd move every strike 5 points. Let's just say it that way. That's easier to do it. And that's what I would look at in the Amazon trade. I like both of these stocks going into earnings. Obviously, I still have a lot of Google. So after earnings, I'm probably going to trim a little bit of my Google position just because it's too big in the portfolio. And I might actually add to Amazon. I still have Amazon in the account. I still have most of the Meg 7 stocks. Micron Technology is a newer position that I put on, and Micron had well, I remember we did a trade on Micron. It went down after earnings, but then came back strong, and that's where Micron is at. I still think Micron is a real solid stock. And the next one that's on my watch list, and kind of surprisingly, I haven't really looked at the stock in a while, but it's really making some headlines on some of the changes they're trying to make in the AI space, which is Dell. So heading into earnings 30 days out, maybe we do a time spread on Dell. I think that's going to be our next trade. We got 30 days out. We'll do a bullish. We haven't done either a diagonal or a time spread where we're going to be using call options and looking for implied volatility to go up on the 30-day, and then we'll sell probably the 16-day. Yeah, I like that trade. I actually like that trade right now. Today is Wednesday. We still have time. And Fundamental Friday, we won't be going through a diagonal trade. And I'm starting to lean into the Dell. So one of, let me pull something up here. One of the things that I read about Dell that kind of caught my attention, and I made note of it, so I'm going on a tangent. By the way, if you have any questions, please do put them in the chat box. Please let people know about Options Guide TV, know the good things that Tradier is doing inside their hub, hub.tradier.com. Profile's free if you want access to all of the speakers inside the hub. And also, if you go to hub.tradier.com, you'll see that the Tradier, well, along with the Chicago Board Option Exchange, or the CBOE now, that's the new name, is going to be doing an event in Florida. So if you're down there in at the end of May, you can stop in and say hello to all the plethora of different speakers that are going on, that are all inside the Tradier Hub. All right, so check that out, hub.tradier.com. I guess that's the moral to my story. I am in here. Look at pulling up. There it is. Okay. Here is the little snippet on Dell that I found very interesting. Dell is no longer a legacy PC maker, in that they're trying to switch the scenario, and they're trying to reposition themselves as an infrastructure provider for enterprise AI. and they're having some success in that. And because of that, like if we look at the charts, Dell is trading at a forward PE right now of about 10 times earnings. And you're seeing the strong move up in Dell. PE, the backwards PE is 22.8 times earnings. And I do think that this can be a catalyst. So we had the strong move up and the pullback heading into earnings. So we were very successful with our last diagonal spread that we did. Got short UAL. That's right. We got short UAL. And with that said, we did a diagonal spread going into United Airlines earnings, and the front month expired worthless. And then after the earnings, UAL got bearish. I feel really bad for the airlines right now. They're just struggling with so many things. Travel, they keep trying. Every CEO comes out and forecasts decent ridership, if you will, going forward. But they just have so many headwinds with the jet fuel and TSA and everything that's in that world. All right. Well, that is our new alert. That means that we have a question inside the chat box. So XOM and CVX are two other big announcements today. What's your take on these? All right. So I like them. I like both of those stocks, but it's really they're geopolitical at this moment. Obviously, big run. If I pull them up, let's look at XOM. And if you look at the chart, we had a strong move up and a pullback. If I had to get long on something, or if I had to pick a direction, I would say that you're probably in XOM going to have a solid earnings announcement afterwards. But once again, this is a headline stock, and it's all about the news that is coming out of the Middle East. So that can trump, interesting word to use there, but that can trump any good news in the earnings report. So if I were to go, especially like we're riding right here, it's almost a head and shoulders though. And let's pull it back a little bit. Let's add some days. We've just looks like we had this is actually called a death cross, where we have the 20-day crossing over the 50-day, but it's all going to be about earnings. So it's not really going to necessarily matter in that aspect. Yeah, that's considered a death cross when you have the 20-day over the 50-day. I think it matters a lot more when you have the 50-day crossing over the 200-day, showing a little bit more of a longer term weakness. This isn't quite that. I think I like, if I had to pick one, I think I'd do Chevron. God, that looks like the exact same. That looks like the exact same graph. Look at that. You can hardly tell. So once again, they're just riding what's going on in the Middle East. But I think Chevron, I think, is the stronger play here. That would probably be the one. If you want to look at, you want me to look at, you want me to, thank you. Do you want me to look at Chevron? I can pull up an open wing on Chevron if you'd like. Don't mind that. But let's work through the Dell trade, because I want to get this one inside the paper trading portfolio. All right. Go ahead and you can share those. Share both of the. There we go. Yeah. I got to give myself credit when credit's due. I made myself laugh. Okay, here we go. Here's the earnings trade. We're going to look at, we're going to sell it a little bit higher. We're going to buy a little bit lower. So we're going to go out to the May 29th expiration, which contains earnings. And I want to make sure that this is right on the earnings. I'm pretty sure it is. Next earnings is May 28th. So the May 29th expiration is the date. So May 28th is the next. All right. And we're going to go buy a little bit out of the money. Let's see what we can get on the 16 strike. 16 strike. We're at 205 right now. We could sell. Yeah, look, we're still good premium. So on the May 15th expiration, 16 days away, the implied volatility is 57. This earnings here that has the earnings date in it is at 66. So you're talking about 9 points implied volatility between the two. Still getting really good implied volatility for Dell looking at the 16 days. So that's what we ended up. That's why we wanted to do UAL. You still received a ton for the shorter term option because vols were just high in the airlines, and they will continue to be high because, once again, geopolitical concerns, the jet fuel, just very volatile times for the airlines. So in this area, I like that this vol is high. We can go a little bit out of the money and we can sell one of these, and we're going to do what's called a diagonal trade. So the Amazon trade we sent to the floor. We're going to go back here, get rid of that. And we're going to buy, the one that we're going to do on this aspect is we're going to sell. That's a 30 delta. You're getting $4 for it. Yeah. Or do we want to go a little closer and get 5? Let's do the 215. I like that. 570. And then let's buy something a little bit closer here and do the 210. Yeah, I like that trade. $7.10. That's a little bit expensive for Options Guy TV. I usually don't spend that much, but I really like that trade. It could be a little bit. Okay, I'll send that one to the what if calculator, and let's look at one more. Let's try to get this down closer to $5. And then I'll explain my thought once we get it in the what if calculator. So let's remove this. We can go a little bit higher, not quite, because we're still getting premium even all the way up here. So if we go here, 220, and we buy the 215, that's a 30 delta. Let's hit this right here. Hit the bid on that. And that one is the 220. So let's go the 215 and buy this one. Not quite $5. Oh, 215, 220. Our Google butterfly just filled. Don't mind this one, but we're got pretty big debit. It's 5 points wide, and we're paying $6 for it. But that doesn't necessarily matter because we have two different expirations. All right, I'll try one last one. Let's go a little bit wider, or a little bit further out of the money. So let's go 225. That delta is 23. We'll hit this one. And let's look at that. And let's go 225, 230. And we'll buy this one. Oops. This one's got to be 230. Yeah. All right. We'll make this the paper trade. I personally like the most expensive one, which was the $7.10. You're buying something at the money. You're selling something a little bit out of the money, but you're going much shorter. And so your net delta on the trade here is $15. So if the stock goes up 1, this position's going to make $15 per 1-by-1 diagonal trade that you put on. Now, you would prefer that the stock would go straight to the 230 level and stop and just expire on the May 15th. But here's the thing. Here's the dynamic that we're working on when we do a trade like this. Implied volatility is higher on the May expiration or on the May 29th expiration than on the May 15th expiration. And we anticipate that implied volatility will continue to go even higher. And the skew between the two of these, or some people will call it the tilt, will increase, will widen. The May 29th expiration will start creeping up in value because that big date is approaching, and that contains their earnings. It expires after the earnings. And the May 15th, a lot of times you're just kind of hoping the stock kind of settles in, waits for the earnings report, and that will wither away. And you're still getting a lot of good premium because it's still trading at the midpoint, or the at the money vol is still 58 in that instance. So I'm really glad we looked at Dell. That was going to be my next stock, and we're paying $5.43. So this isn't nothing to sneeze at. We're talking about $543 per 1-by-1 diagonal call spread that we have on. And we're going to send it to What If Calculator, and I might explain it a little bit better. But you can't fall asleep on this trade. If you put this trade on, you have to watch it, and you have to have an alert. You don't want it to run too much against you to the upside, because then you become negative on the trade. And you don't want it to run too much against you to the downside. You just kind of hope it hangs out in this level and slowly drifts up towards that 230 strike. But you're trading volatility here as much as you are trading the movement of Dell stock. So ideally, the front month expires, the May 15th expiration expires worthless, and then you are just long a call at a very cheap price. Why do I say cheap? Because you're going to use the premium of the one that you sold to help pay for the one that you are long. And then if implied volatility starts going up on that option contract, well, then you're doing well, right? Because you're just long a call. Obviously, you want implied volatility to go up at that point in time. So let's send this one to the trading floor. We'll say 550. Work that trade. So here we go. On Dell, we're doing a call diagonal spread. We're going to buy the 225 strike call with the May 29th expiration, and we're going to sell the 230 strike call with the May 15th expiration. We're going to get this done for a net debit of $5.50 or $550 per 1-by-1 diagonal call spread that we execute. And that order has been sent, and we're working that right now. And it looks like we filled our Google trade. So let's go in and take a peek at our Google. Yep, we filled that at $3. I like that. I like, even in the paper trading account, we got it filled at $3. So Google, come off a little bit. Let's go look at where Google is at. 351.65. Yeah, it's down a little bit from the beginning of the show. That never usually works for us. Usually, every time we start the show, it seems like the market knows that we're talking about an underlying, and it starts running away from me, going the wrong direction almost every time I start a show. But with that said, that's good. We're right at the time, 11:29 Eastern time right now. So that's going to be it for this edition of Options Guy TV. If you have people that are interested in options, we're going to start Fundamental Fridays. Well, we've already started it. We've done a few shows. You sign up for, anybody can attend, but if you'd like to paper trade along with me, there's a way to go to Tradier.com and open up a paper trading account. And then you can trade right along, look at all the trades that I have on, put them in your own paper trading account. And we're going to learn about the fundamentals. We're going to talk about vernacular. We're going to talk about execution. We're going to look at the whole gamut of option trading. And if you sign up for that paper trading account, we will also send you a series of videos on the basics of option trading, a 4-part series. So let people know this Friday. And my name's Brian Overby. Follow me on X.com. I'm on X.com. I'm at Brian Overby. And I'll see you this Friday for the next edition of Options Guy TV. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.